In one of our previous videos, we talked about the foreign earned income exclusion, and in this video, we're going to talk about a related but very different tax provision called the foreign tax credit. If you're a US expat living abroad in another country, you're definitely going to want to watch this video because avoiding double taxation, which this credit is designed to do, is something that you ought to know about. But before we do that, make sure you hit that like button. It costs you nothing and it really helps us out in the algorithm so we can get this content into more people who really need to see it. Now let's dive in. Foreign tax credit is a U.S. tax provision that allows taxpayers to reduce their U.S. federal income tax liability by the amount of income taxes that they have paid to a foreign country or U.S. possession. Basically, what it's designed to do is prevent double taxation, which can occur when U.S. citizens or residents are taxed on the same income by both the United States government and a foreign government. The foreign tax credit provides a dollar-for-dollar reduction of your U.S. tax liability, meaning every dollar you pay in eligible foreign taxes reduces your U.S. tax by the same amount. In other words, and maybe this is easier for you to remember, expats pay the highest tax rate between the U.S. and the country of residency. So for example, if you owe $10,000 in U.S. taxes, but you paid $8,000 in eligible foreign taxes, you can claim an $8,000 foreign tax credit, which reduces your U.S. tax liability to $2,000. The foreign tax credit covers any type of income that is subject to both U.S. and foreign taxes, including earned and unearned income, like dividends, capital gains, and rental income. Also, there is no residency or physical presence requirement. You simply need to pay or accrue income taxes to a foreign country on income that is also subject to U.S. taxation. The following types of foreign taxes qualify for the foreign tax credit. 1. Income taxes paid to a foreign country or U.S. possession. These are direct taxes on your earnings, whether from wages, dividends, interest, or rental income. 2. Taxes on foreign business income and investment income. If you run a business or you have investments abroad, the taxes you pay on these earnings can also qualify you. We also have taxes on foreign source income. This includes any income earned abroad or from foreign investments, ensuring that your global earnings are fully considered. The tax in question must be an income tax or its equivalent. This excludes indirect taxes like value-added tax or sales tax, except when they substitute for an income tax. So let's say we have a remote IT specialist from Florida with an income of $95,000. We'll assume for this example that the foreign tax paid is $25,000. In this case, the federal tax bill before the foreign tax credit is $18,000. So this individual can claim a foreign tax credit for $18,000, meaning that the federal tax bill after the foreign tax credit is zero. There's also Florida state tax, which also comes to zero because Florida does not impose a state income tax. Total tax savings, $18,000, with no additional state tax due. Now, note that the foreign tax credit is distinct from the foreign earned income exclusion. While the foreign earned income exclusion reduces your taxable income by allowing you to exclude a certain portion from federal income tax, the foreign tax credit provides a dollar-for-dollar reduction of your U.S. tax liability. Now, you can combine the foreign earned income exclusion with the foreign tax credit, but not on the same income. So let's say you earn $150,000 abroad and you pay $15,000 in foreign income taxes. You can use the foreign earned income exclusion to exclude the first $130,000 from U.S. taxable income. That means you can use the foreign tax credit to claim a credit for the $15,000 in foreign taxes paid on the remaining $20,000. Claiming the foreign tax credit requires a clear understanding of the steps and the rules. Step 1 is to confirm your eligibility. First, you have to make sure that you actually meet the foreign tax credit eligibility criteria. Reference the previous chapter for details on that. Step 2, choose deduction or credit. You can opt for either a tax deduction or a tax credit. A deduction lowers the amount of income subject to taxation, while a credit reduces the final tax owed. Foreign income taxes reduce U.S. taxable income when taken as a deduction. Typically, the credit is a more beneficial and straightforward way to reduce your tax, but it's up to you, so make sure you consult a qualified professional. Step 3, filling out Form 1116. Make sure you attach this form to your tax return. Step 4, currency conversion. Make sure you convert foreign taxes to US dollars using an appropriate exchange rate. Step 5, understand the limitations. Remember that the credit can only be up to either the sum of the US tax owed or the foreign tax credit limit for that year, which was $126,500 for tax year 2024. Step 6, make sure you know how to handle excess credits. Excess credits can be carried over or back to other tax years. Step 7, filing the return. Attach Form 1116 to your federal tax return, keeping an eye on deadlines and extensions. These can sometimes vary for expats, so make sure you keep it in mind. Now, one great thing about the foreign tax credit is that it's very flexible. You can take advantage of something called the carryback, which means that you can apply unused credits to the previous tax year. This might mean amending last year's return, but it could get you a refund. We also have the carry forward. Any leftover credit you don't use this year or carry back can be rolled forward for up to 10 years. After 10 years, though, they expire, so make sure you don't let them sit there forever. Another bit of good news is that if you qualify for the foreign tax credit, some states might allow you to exclude your state income tax on top of that. Then again, there are states like California which don't recognize the foreign tax credit at all. So if that's the case, you might want to consider moving your domicile to a low tax state such as Florida. Now, if you're looking for a quick and easy way to get a Florida address for tax purposes, make sure you check out our service at Savvy Nomad. Links in the video description, and make sure you use the code YouTube for 15% off. Now, if you enjoyed this video and you want to learn more about expat and nomad tax tips and financial strategies, make sure you follow the channel. We're always putting out new content. And don't forget, if you haven't done it already, hit that like button. It costs you nothing, but it really helps us out in the algorithm so we can get this content to more people who really need to see it. So with that said, safe travels and happy tax planning.